Hello, and welcome to the Long-Term Investing Podcast with Baskin Wealth Management. I'm Barry Schwartz, Chief Investment Officer. Baskin Wealth Management is an independently owned investment management firm with over $2 billion in assets under management, providing customized wealth management solutions and services to families and foundations. In this podcast, we ignore all the noise and have conversations that make sense about the things that matter in today's markets. It's what we talk about with each other here in the office, and we want to share those conversations with you. Please stay tuned for our legal disclaimer at the end of the episode. How's it going, everybody? This is the Long-Term Investing Podcast with Baskin Wealth. I'm Barry Schwartz.
Ernest Wong.
That's it? Just Ernest Wong?
You said you were Barry Schwartz.
Yeah, I know, but I said I'm Barry Schwartz. You said just Ernest Wong. Anyway, that was funny. But what's not funny is how well this podcast is doing. We're at record listens right now, and so we really appreciate all your support. If you like this podcast, please subscribe to us on YouTube, on Spotify, and on Apple, and wherever else you find your podcast and you like to listen, you'll find us. We are in the thick of summer here right now. Maybe people are focusing on enjoying themselves at the cottage, on a vacation, playing golf. But if you ever need any help with your portfolio, we're here. We're not going anywhere. And we'd love to talk to you about our services and what we can offer for you. Baskin Wealth manages about $2.7 billion for over 1,200 families across Canada, and hopefully soon we'll be able to offer our services outside Canada. So with that, we have an exciting show this week. We're going to talk about the Couche-Tard 7-Eleven drama. Looks like it's now over, as well as talk about one of our recent purchases, Taiwan Semi. The stock has done quite well since purchase, and we'll talk about the rationale and the reasons why. It's pretty easy to understand, though, of course. The spending on AI is insane. So, Ernest, the markets are very strong coming out of the April pullback. I see at one point the NASDAQ was down about 20%. That's, like a bear market, pretty nasty pullback. And now up, 10% for the year? S&P up 6% for the year. It's amazing. So if you don't like the markets, just give it a minute. It's not, we say it all the time. It's not like the news has to get better for the markets to improve. It just has to not get worse. It looks like the markets did price in all the worries about the tariffs. And of course, the economic numbers seem to be still pretty decent, as well as the corporate earnings that I'm seeing. We're already in the thick of Q2 earnings. They've just been phenomenal, right? We've seen reports from BlackRock, so strong, from Taiwan Semi, so strong, ASML, strong earnings. Maybe some of these companies are warning or giving some guidance about some of the impacts on the tariffs. But I think it's important to remember that most of the S&P 500 are services companies, right? They manufacture very little. They're knowledge-based businesses, and there shouldn't be too much impact from tariffs. What have you been noticing that's going on in the markets, or any?
Well, what are we worried about these days?
Yeah,
right?
I don't know what I'm worried about. It's
yeah.
I guess I was worried about yesterday that, so we're recording this today on July 17th. It's my mother-in-law's birthday. Happy birthday, Phyllis. But what I wanted to say is the other day, Trump, there was, tweets that he was going to threaten to fire Jerome Powell again. Yep. And that kind of got the market concerned. I think Jerome Powell, the head of the Federal Reserve, I think his tenure is up till May 2026. I don't think he can be fired by the president.
No.
So I don't understand the nonsense there, but, we understand how Trump works. He says crazy things sometimes. Maybe a lot of the times he says crazy things. Not sure if he actually means it, or he's just, trying to poke the markets and see how they will react to different things that come out. Markets didn't react positively to that worry, but clearly there are lots of worries out there and things we don't know about, but it's best just to focus on the companies that we own.
Yeah, we pay attention to this stuff, and you never know exactly which data point could cause a sharper reaction in the markets. And I think one of the things that I really strongly believe is that you can't predict or time the market in terms of being able to know what stock prices are going to do in any given month or even a year. But that's why we own like a basket of high quality companies, that where we think that even if there's all these things going on around the world, they're still going to be able to deliver earnings growth over time.
That's right. And stock prices in the short term are an opinion, right? There's so much that goes on to determining stock prices, whether it's money flowing to different sectors, different industries, different countries, whether there is a rotation out of specific industries into hotter industries. And so you never really can get an idea of what's fair value for a stock. I think one of the things I like to tell clients is, especially when they laser focus on some of the names in their portfolio that are down, and we'll talk about a name that was down and now it's up, right? Is that as long as the fundamentals of that business are still going in the right direction, or your research tells you that things will improve from here, the only thing you should be doing is buying more, right? You should it is a mathematical exercise, investing, right? Sure, there's vibes, there's sentiment, but at the end of the day, it does come down to there is some quantitative rationale for investing. And if a stock falls a lot and the fundamentals haven't fallen as much, or maybe the outlook is good, but not as good as it used to be, but still it's not material, you should use that as an opportunity. And that's typically what we do with our portfolio, right? We have a few names that are underperforming this year. We talked about it on our last podcast with the mid-year update. We talked about names like Copart and Apple and TFI International. We believe in these companies. And Couche-Tard, of course, same thing. The stock's down year to date. These are companies that we're going to give the management teams the benefit of the doubt. These are companies that have delivered excellence in capital allocation and logistics and running their operations, and have been through tough times before. As long as the world hasn't completely changed for its business, you should, I can't say you, but what we do is we buy more, and we're happy to buy more of an underperformer. There's these dumb sayings that say losers only average down, or losers average losers.
Yeah, don't water your weeds.
Yeah. Don't. Yeah. Well, I mean,
no. Okay. Yeah. No, I think that's an important point, because I think the way that we invest here is maybe a little bit different than how some other firms might approach it. So I think Copart, for instance, right? I think there's been a lot of discussion about Copart, especially in the last quarter, when they started. I think their performance was significantly worse than their primary competitor.
Yeah.
And so there's a lot of kind of chatter about, well, are they losing market share to IAA, Ritchie Brothers? Is the growth that they've had all along, is that starting to come to an end? And then there starts to be some alternative data sources that come out saying that, it seems like State Farm shifted some volumes in Michigan from Copart to IAA, so something like that, right? And so at Baskin, we don't pay for any of those alternative data sources. We're not scraping credit card data or paying for satellites on parking lots to try and make stock price predictions, and the reason that we don't is because we trust the management of the company. We believe we've studied the track record of the management at Copart, the way that they've built up the business and acquired land to grow and build up the customer base in emerging markets and gain share over time by doing the right things. And so even if there's a slowdown in results, I think I'm inclined to stick with the management that I know and trust, that has delivered over time, rather than, panicking and immediately selling and moving on to something else. It's kind of like if you have LeBron James on your team, he's LeBron James, but then maybe there were 2 games in a row where he scored a little bit less than usual.
Yeah.
Like you don't trade LeBron James. You stick with him because you think he's a great player. And I think that's generally how we like to think about things.
That's right. And you've said it multiple times. Good companies, good surprises happen to them, right? On the upside. And so Copart is beautiful balance sheet, still generating strong gross margins, generating a lot of free cash flow. There's optionality there with that cash. There's potential for further expansion into other auction areas, as well as further expansion into other territories outside North America. So there's big potential there, and so we don't let the stock price. I mean, it does somewhat dictate your mood on a stock, of course, right? It's easy to get depressed, and why are we holding that? Oh, and it's going down, and now it's at a 52-week low. Shit, I should have sold it at 60, and now it's $46. What am I going to do? I can tell you what we're going to do. If the stock has fallen well more than what we think the fundamentals are falling, we just have to buy more of the stock. It just makes sense to us if we still have a firm belief in the long term of the company. And overpaying for a stock like Copart at when it was $60, it was trading at a high multiple, no question. It's still one of the world's best businesses at a 52-week low versus a 52-week high. And so, investing is being patient and letting these temporary issues go by the wayside. And there'll be more problems, more issues with every single company that we own. We can't predict it. But I think one of the things that we want to use is the market volatility to our advantage. And so we're patient enough investors that we can sit on names that have underperformed for quite a long period of time and accumulate more, especially if we believe in the management team. Maybe we'll get it wrong. Maybe Copart is a sell. We'll have to determine that over the future. But we're not going to let 1 or 2 quarters of underperformance dictate how we should react.
And I mean, one last thing to add is that's why we own like 30 stocks, because some of them, just the nature of business is just that something's going to be happening at some company at one point or another.
Yeah.
And, and that's why we don't put all our money into 5 stocks, because some of them are going to do well and others aren't not.
Well, our approach, and whether right or wrong, is to treat all of our clients' assets as if we're managing the client assets that we're managing as if we're managing every single dollar of their assets. That is our approach. We're not a hedge fund. We're not trying to get the best performance by being concentrated. That may or may not work. What we're trying to do is more focus on protection of clients' portfolios. And if they want to take on risks and buy, Bitcoin and crypto and all other, stuff that is not publicly traded or whatever, there's lots of places they can do it. They don't have to do it through us, and we're fine with that. We don't need to be everything to everybody, and that's the approach we take. So, talking about stocks that have underperformed, Couche-Tard it hasn't been a great success since we bought it, but Ernest and I were talking last night. We saw at around 7 o'clock last night that Couche-Tard withdrew its acquisition of 7-Eleven or 7 & I, the parent company of Japan, with a very strange and very long letter explaining every single reason why they can't work with the 7 & I management team. So, Ernest, you read that letter in depth. I read it. It gave me a little bit of a headache, and I didn't really feel like taking notes on it at 8 or 9 o'clock at night. But you did. So let's talk about why Alain Bouchard and the Couche-Tard management team again have given up on acquiring 7-Eleven. This is the second time they've tried to do it, by the way. Yeah,
it was a weird letter. There was a part where they were describing how they were meeting with one of the group presidents at 7 & I.
Yeah.
And he was talking about the way that international licensees, the licenses work. And then the CEO of 7 & I, made this gesture.
Yeah.
This was all in the letter.
Yeah.
He made this gesture to tell him to, think before you're talking.
Essentially, shut up.
Yeah. Shut up.
Yeah.
So And that's kind of a pattern that I think we've seen not just in the not just in the letter, but throughout the entire year of engagement when Couche-Tard has been pursuing Seven and I, where I think everybody got the sense that Seven and I didn't really want to sell to Couche-Tard. Whether it's because of, Japanese nationalistic sentiments or some other reason, like, I don't know.
I've never been to Japan. You have, but the 7-Eleven brand is iconic in Japan, correct?
Yep.
Yeah,
we talked about this before. It's totally, convenience stores in Japan are totally different to what we're used to in North America.
Yeah.
And so
it's kind of like when Burger King bought Tim Hortons, right? Everybody was worried you're going to lose the cultural brand, and still people complain about how bad Tim Hortons is. I seem to remember, though, when I owned the stock when it was Canadian owned, they complained how bad it was then too. But going back to 7-Eleven, I digress.
No, so I think this is interesting for a variety of reasons. The whole process it's almost been exactly a year, because I was actually in Japan when the offer first took place. And I think if we look back to the time that Couche-Tard made the offer, I think the underappreciated aspect of all of this is how opportunistic it was of an offer. I think there's a lot of chatter about how the management of Couche-Tard, like Alain Bouchard himself, like it's all just kind of ego-driven empire building, like grow the business just to grow it.
Well, in all fairness to the pundits, it was a big bite, right? It's essentially almost the size of Couche-Tard buying another company of the same size, right? And the potential of issuing that much debt or some equity to make the acquisition would have been staggering. And I think that scared a lot of long-term investors, maybe some pension funds that own Couche-Tard. Hard to know. And then, of course, the results at Couche-Tard have not been as juicy as they were the last few years. So the timing kind of stink.
No, but the timing of the timing of the offer was highly, highly opportunistic.
Yeah.
Because if you think back to August of 2024, there was a mini stock market crash in Japan.
Okay.
So Japanese stocks were cheap. 7-Eleven's whole business had been underperforming for quite a while now. And there were activist investors on board looking for a change.
Yeah.
I think the stock was trading at something like 5 times EBITDA, which is much lower than basically anything that you could find in North America.
So kudos for the Couche-Tard management team for recognizing the value and the opportunity at that time.
Yeah. And then the yen was at a low point. Borrowing costs in yen were very cheap. Couche-Tard stock was like over, I think it was over $90 at that point.
Yeah, I was around 80. I was doing
80,
well.
$90
Yeah,
bucks.
so it was near an all-time high. Yeah.
And the Japanese government had just started putting out shoots that they were open to reforming the culture and investment in Japan.
That's right.
So allowing more foreign investment into the companies.
All right, that sets the table perfectly for.
And so it was very carefully timed to take advantage of the weakness that 7 and I was currently in. And so since then, I think quite a few things have happened. Number one is that, first of all, 7 and I dragged their feet, kind of refused to really seriously engage in the process, all the way even up to through the NDA that they signed a couple of months ago. Borrowing costs have gone up, especially in Japan, where I think the 10-year today is over 1.5%, which is still kind of crazy to say it that way, but it was, I think at some point it was almost zero, right?
Okay.
So borrowing costs have gone up. Couche-Tard's stock price has fallen. Fell, I think it was what did it bottom at?
Well, about 66,
Yeah.
$67.
It's under 70
So
bucks
yeah,
for sure.
yeah. So it fell about 15%.
Yeah. So the dilution for this equity that they would have been issuing is tougher. And then Seven & I itself had made some reforms to its business where they sold the supermarket business. They announced a spin-off of North American business, and then they have a new CEO. So they just did a shareholders meeting, Seven & I did, where everything went smoothly. So I feel like maybe they felt less urgency that they have to seriously engage with Couche-Tard.
And I think their most recent earnings release, they saw an improvement in the results.
Yes,
right? Is that
some
so?
improvement?
Yeah,
Yeah,
some improvement. So maybe that gives them the confidence to say, we don't need to have a fire sale. Let's let these changes that we've made, selling off non-core assets, focusing on improving results before we have to sell or put ourselves up for auction.
Yeah.
Right. And so that's where we are today. Right. So
Yeah.
Couche-Tard stock has recovered to the mid 70 range. Seven & I stock fell last night in Japan, but still higher than what it was in August prior to the potential acquisition. So where does this leave Couche-Tard shareholders today?
Right. I think the good news for Couche-Tard, I think that both of us have been pretty open about the fact that we thought the market misunderstood this deal, that it would have been an absolute home run if they could execute on it, and that it's a missed opportunity, that they couldn't do it. But, the stock market's up. I think the stock market's bidding Couche-Tard stock up 10% as we speak. So I'll take it.
Yeah, we'll take it. It was interesting when reading the letter how they tried to come up with some different structures to get the deal done. Couche-Tard said maybe we'll just take a minority stake in the Japanese assets, but let us buy a majority or a full stake in your non-Japanese assets, so and we could work and fix those and sell gas stations or convenience stores that the government wants us to sell. They offered that they would even I think put in a bunch of money if the deal didn't go through.
Raise the break fee.
Yeah. So like Couche-Tard was willing to really roll out the welcome mat to acquire this great assets. And 7-Eleven is a great brand in the United States. But the integration, for Couche-Tard, they are the most excellent retailers that we've come across. And so one of the things that was shocking to us, yes, we know that the results from Couche-Tard recently haven't been the most exciting. Europe and Canada doing fine, but United States still having some same-store sales growth issues. But this is a company that has proven time and again that they are excellent acquirers, excellent operators. They know how to cut costs. They know how to integrate. They know how to get benefits from synergies from making these acquisitions. They've made a smart acquisition of Get-Go, which is going to help them improve their food. I was at my local, Circle K in Canada, and I see that they've improved the food tremendously. I noticed they're now offering hot and fresh pizza, as well as burgers, breakfast sandwiches, donuts, small cookies, big cookies, warm Danishes, right? So they're trying to increase their offering in food, which may work over time. Certainly a big upgrade from what I've seen in the past.
So I think the thing that... So a few things here.
Yeah.
The first thing is that the interesting thing from the letter was that Seven & I had proposed to merge the North American business with Couche-Tard on a stock basis, and Couche-Tard said no. So I think that's really reassuring to me as a shareholder, where Alain Bouchard, the chairman, like, he's doing this to make money, right? He's not there to grow the business without considering the impact to shareholders.
So flesh that out some more. So the Japanese countered by saying let's take the North American 7-Eleven and all of Couche-Tard, put it together as and make one new company.
Yes.
And 50-50?
Well, they didn't say the exact
Okay.
split. I would be shocked if it was 50-50, but
Yeah.
Alain Bouchard said no.
Yeah.
Right. And I think this really speaks to the incentives that are in play here, because Alain Bouchard, I think himself owns about 12% of Couche-Tard. I think that's worth $6-7 billion. So that's like, he has a lot of money invested in the company, right? And so, to the extent that there was a proposal where it's like, okay, you get what you want, but you're going to get diluted significantly, he said, no, I'm not doing that. I'm here to make money. And so I think you can imagine a scenario where if there was a board and a CEO that did not have meaningful skin in the game, they would have accepted that deal because on paper, it made perfect sense. And you could sell it to shareholders to say, look, we're doing a stock deal. We're growing our business substantially. The empire that they're going to be running is significantly larger, right? But it comes at the cost of the shareholders, not at the cost of their own money. And so that's something that you really like to see in a company, and why I think I have a lot of confidence in the business going forward.
I also think from an operational standpoint, I think Couche-Tard wants to be the decision makers.
Yes.
Right. It's clear from the results of 7-Eleven that they haven't been as good operators and haven't been as good retailers recently. So Couche-Tard, they don't want to share the glory.
Yeah. And so I think if we're thinking about what's happening to Couche-Tard going forward, I really think there's no change in plan, because one thing that they've been very clear about from the beginning was that it was a very small team at the headquarters of Couche-Tard that was pursuing this deal. There was no distraction to the rest of the business, and maybe the CEO himself had to participate in meetings or whatever, but
they made a website.
Yeah.
I'm sure they consulted lawyers and accountants.
Yeah.
There was no break fee.
Yeah.
Right. So maybe a few $1 million were wasted.
Yeah.
And some flights and some, restaurants and hotels, but it wasn't a major expense or distraction for the market, of course, because the market did not like this deal whatsoever. I couldn't find anybody that was positive on it. The long-term shareholders were worried about the potential of dilution as well as staggering amount of debt. Plus, I think the recency bias of, the stock's been performing poorly recently. So it was really hard to find anybody bullish on this potential. But you and I, doing the math, we thought it would have been spectacular. We thought there was a chance of Couche-Tard listing their stock on the U.S. exchange as a result of this acquisition, increasing their investor profile. So that's where we are today. But what are the catalysts moving forward for Couche-Tard?
So I think if you go back to 2023, before all this stuff happened, they had an investor day where they were talking about the things that they're planning to do over the next couple of years.
Yeah, I think it was a 5-year plan, 2028 plan.
And so in the plan for then was about $10 billion of EBITDA by 2028. And so they just did 6 this year.
And it's
so that's
2025 year.
Roughly 18% compounded through to 2028. And the way that they get there is by just running the stores well, adding food to the stores, adding EV chargers in places where it makes sense, doing acquisitions. Because one of the things I think people forget is that it's still a very fragmented convenience store landscape. I think in the US, they only have like 5% share.
Yes.
Where like over half of the stores are mom and pop independents. So there's a lot of room for them to make acquisitions. They talked about doing acquisitions in Europe, in Asia Pacific, where they basically have nothing, and in even Latin America, where they have nothing, right? So a lot more opportunity for acquisitions. And then one of the things that I think the investors will like is that they'll probably ramp up the buyback as well. because that's been one of the overhangs on the stock, because historically they've done some buybacks and that's propped up the stock price.
And there's still a number of oil majors that own gas stations and convenience stores that may not make sense, or if when oil prices go down, they may look to get some cash out of it at higher valuations versus their stock. So there's so much potential for Couche-Tard to make acquisitions. One of the things that Couche-Tard stopped as it was in discussions with Seven and I was its share buyback.
Yeah.
Right. Couche-Tard over the last few years has been very aggressive buying back its shares, buying back anywhere from 3 to 5% of its shares a year and making a meaningful dent on its share count. I guess they put that on hold mostly over the last year. There's been a few times where they bought some shares, but not material. But one can imagine, given that Couche-Tard's leverage, because they were building cash and trying to improve the balance sheet for this acquisition, it's now well under its target. So there's potential to leverage the balance sheet, acquisitions or buybacks. Still, even though the results have been meh, it's still generating an enormous amount of free cash flow that can be used now for buybacks and acquisitions going forward. Couche-Tard's not really much of a dividend play, right? It's an immaterial dividend. And as well, one of the things that the company is focusing on is improving the results at the stores. Some of it is macro, some of it is self-induced. But this is a company that has performed so incredibly in the past. I think prior to this year, this was a stock that had compounded over a 15-year period at well over 30%. So I will once again give the benefit of the doubt to a strong management team with skin in the game that knows how to run operations in a very fragmented industry. And as a result, Couche-Tard's valuation has fallen. It used to trade at a premium to some of its U.S. peers, now at a big discount. And so that overhang and that worry is gone. We'll see what Couche-Tard has to say. Whether or not they meet those 2028 targets, don't know, don't care. I don't know, we don't know what acquisitions they'll make. We don't know what improvements will happen. But we're looking at today and now, and we see a very attractive situation. When the stock was in the midst of the acquisition, we said this is an asymmetric potential.
Yeah,
right?
You called it.
Yeah, I said there's no downside here. The downside is it's already priced into the stock. Either they win 7-Eleven and make a bunch of money, or they walk away and the market likes it. And so that's where we are today. And I think there's potential for the company to get back to double-digit earnings growth. The bottom line is that's what we need for the stock to do well going forward, right? And that's what we're looking for when we own companies, is the potential for double-digit earnings growth. And I think Couche-Tard has the elements in place. If it can improve organic growth, buy back some shares, make acquisitions, that shouldn't be a pretty low bar for it to resume double-digit earnings growth. Anything else you need to say?
Well, I think you see this from Couche-Tard from time to time, where they're always looking for the big fish that they can catch, and sometimes it happens, sometimes they don't. I think it was, I don't remember what year it was, but I think they tried to buy the French supermarket before.
I know it was 2020.
Yeah.
And they abandoned that deal, and I was looking at it last night, January 2021. And similar to what happened with the stock fell about 15%.
Yeah.
And then 3 years later, the stock had doubled, right?
Yeah, and that was one where I think investors were kind of questioning. It's like, what are you even doing buying French supermarkets like when you're a convenience store business? But I think we'll see them. I think we'll see this again at some point. So, but I like the stock here too.
We very much like the stock, and this is not one that's in a fantastic, sexy business which has supreme competitive advantages. Well, no, we can't say that. But what we can say, Ernest is kind of like, well, maybe they do. But what we can say is they do have significant competitive advantages in capital allocation and retail excellence. It's one of the best managed companies we've ever seen. I would put it right up there with a Costco or a Walmart in terms of running their operations. And what I love about it, and I think you would agree, is the four founders still own a majority, not a majority, but a meaningful stake in the company.
Yeah, I think 18%, something
Yeah,
like that.
that's no joke, and they're not young guys.
No.
No. So that's our take on Couche-Tard. We'll be watching it over the next year. The deals could come back to the table too, right? We'll see how.
Yeah, there was a headline that now they might 7-Eleven might not do the North American spinoff
Why?
because the deal's not happening.
So okay.
But we'll see.
Yeah. So I mean, that's why we always prefer to stick with companies that are open in countries where shareholder rights and shareholder maximization are the most important factors. We're not sure what the motivations are of the 7-Eleven management team, or sometimes these closely held family companies in Europe or Asia. It's hard to know exactly what they want to achieve or what they're trying to do. That's why we always gravitate more to North American businesses, maybe some Western Europe.
Well said.
All right. So we had results from Taiwan Semiconductor, I guess last night or this morning. We just bought the stock. I urge you to check out our podcast that we did on Taiwan Semiconductor. I think Ernest. I don't know why I called you Erwin. What did you? It's a compounding machine or something. What did you call Taiwan Semiconductor?
It was
The strong moat.
the strong moat compounder.
The strong moat compounder. So TSMC is.
Yeah.
So we've seen, Ernest, over the last few months, last few weeks, just the insane spending on AI. We've seen Meta poach a number of high quality AI researchers from Apple, from OpenAI, from other firms as well. We've seen, we don't know what contracts they've been offered, but we've heard they're gigantic.
Yep.
And we saw Zuckerberg announce that he's going to spend hundreds of billions of dollars on AI going forward.
I think it's called Prometheus.
Prometheus, right? Prometheus brought knowledge to the world. He was a champion of mankind against the gods. So maybe Zuckerberg sees himself as Prometheus. The interesting thing is, there's a lot of ways, of course, to play AI, right? In terms of you can buy companies that build the data centers, make the cooling equipment, that sell the cloud equipment. Obviously, the number one way is you own the chip maker, like NVIDIA, which seems to be winning. We decided to go another direction and buy Taiwan Semi. There's no end to some wonderful businesses involved in semiconductor production. ASML is another one we've talked about. Taiwan Semi, of course, NVIDIA. There's Marvell, there's Broadcom, there's the security guys. There's just, but what we're looking for is it has to be the Baskin wealth idea. It has to have a reasonable valuation. It has to have management teams that have strong skin in the game. We're looking for smart capital allocation, history of profitability, high returns on invested capital, and Taiwan Semi really fit the bill for us. So what did the company say? We really haven't, I think we'll cover more of it in the next few weeks, but what was the initial comments that you read?
So demand was really good.
Mm-hmm.
I think they're expecting sales for the year to be up 30% in US dollars.
This is $1 trillion company, by the way, right?
Yep.
So the $1 trillion company expecting its sales to grow 30%. It's unbelievable.
They're accelerating their build out of fabs in the US.
Mm-hmm.
Partly because I think they've been given some extra tax incentives, but more so because they said that there's just nonstop demand for fabs.
So it's really interesting, right? You hear AI, you see the spending hundreds of billions of dollars. So you just say, oh, maybe I'll just buy Intel, or maybe I'll buy Samsung because everybody's going to benefit. But that's not the case.
Yep.
Right. Taiwan Semi is running away. They're the ones that have the demand. They're the ones that have the production. They have the technical knowledge, and Intel and Samsung are well behind of Taiwan Semi, but at one point they were well ahead. So that's why when Intel and Samsung, they may benefit for sure from AI, but you want to gravitate to the guy who owns the choke point, right? Isn't that what Taiwan Semi does at the moment?
Yeah, so there's been some reporting that Intel and Samsung have been canceling some of their their current projects because of lack of customers. And no, I don't know if that's true or not. Like
we
there's a
never
lot
know.
of reporting about a lot of things.
You see a tweet, you can't always take it for face value.
But then I think TSM pretty strongly said that for both the N2 node and the A16 node upcoming, basically everybody is their customer, and there's very, very strong demand for all of these process nodes. So basically putting to rest the rumors that just because Intel is focusing, like is stopping their current production line and focusing on the next one, in the end of the day, TSM is still going to do its thing, and it's doing very well.
Very good. Ernest, summer's always a time when people like to take some time, relax, read some books, go on a vacation, you're flying, and any books that you want to read this summer that's on your Kindle or on your desk, or that you might take with you on vacation?
So I'm about 3/4 done a book called Apple in China right now, which is a book about, it's a very, very well-researched book about Apple's process of shifting its manufacturing to China.
Yeah.
And it's a very, very well-researched book and very, very easy read. It's written like a thriller.
I just started it, by the way, and it's very fascinating. Just, I'm not going to give away any spoilers about it, but Apple at one point was in big trouble, right? And so they needed to. Steve Jobs was a perfectionist. He liked to control everything. He controlled the design, controlled the manufacturing, but that's not always possible. And they figured out that they can outsource this and focus on what they're best at, which is design and software, and less on putting together these components and making the chips. And so, I mean, things come around and go around.
Yeah.
Maybe maybe in the future, Apple will be making their own stuff again. Don't know. But so far, I've enjoying that one as well. I'm reading a book I finished a book called The Compounder's Element. It's I can't remember the author, but you'll please do a Google search on the book, or on Amazon. It's an interesting book about, and fits with what I'm looking for, is talking about long-term investing, owning compounders, how you find them, what elements go into finding a compounding investment, and I think it's all the stuff we already know, but it's important to read these things over and over, right? If a lot of people know the Bible by heart, but they read it every weekend. So these are things that can add to your knowledge. You forget stuff. I like rereading the Buffett letters. So you got Apple in China. I also have Apple in China that I'm starting. Anything else that you want to get to before the summer ends?
Yeah, there's another. So there's no reason, like I'm not studying China intentionally for any reason, but there's another book I'm reading called House of Huawei.
Okay.
Which is about the rise of Huawei and how it was built as a company, especially how it, and I think it's fascinating because the way that companies were, like, if you look at how companies like TSM or Huawei started, it's very different from how, like, Silicon Valley style tech startups start today, where they have an idea and then they have VC funding and then they kind of scale up from there. Mm-hmm. Whereas Huawei was literally like a guy who grew up like through the revolution and had to scrape together parts and use every tool in his baggage, including political connections, to kind of grow Huawei into the company that it is
Unbelievable
today.
Company. Huawei's involved in chips, involved in consumer products like phones, makes cars, right? Is it in the car business too? EVs?
I think they do.
Yeah, so it's everywhere. That's one that looks interesting. There's also the book about ASML. Have you read that one?
No, I didn't know there was one.
Is there the ASML way? Is there a book about that?
Maybe, yeah.
Maybe, yeah. And is there any, I thought I saw somewhere where someone said that there was a book written by Morris Chang, but it's only it hasn't been translated into English?
Yes, that's only available in Chinese.
Yeah, okay, well, that's not going to work for me. So we'll have to hear when Ernest is done reading those books.
I actually can't read Chinese.
You can't. Well, guess we share
For
that
those
in
who
common.
are wondering about that.
Yeah, no, I can barely read English. So with that, we'll see you back here next week, and I hope everybody's having a great summer. And let's go TSM. Take care. This podcast is for informational purposes only, and any forecasts on the economy, markets, or individual securities should not be viewed as investment advice, a recommendation or an offer or solicitation to buy or sell any securities. Clients of Baskin Wealth Management and the speakers on this podcast may own shares of the companies discussed. Information on this podcast is current as of the time of production and is subject to change. If you have any questions or would like to subscribe to these podcasts, visit our website at baskinwealth.com.